Hi, I'm Steve LaFrance with Blakely Financial, and the stock market's bumpy ride continued during February. Last month's top story was rising geopolitical tensions and Russia's invasion of Ukraine. The headlines briefly pushed the S&P 500 into correction territory, which is defined as a decline of 10%, before U.S. stocks recovered a portion of their losses. International equities also traded lower as investor risk appetites declined. In the commodity markets, energy prices increased amid fears that geopolitical tensions would disrupt oil output and worsen an already undersupplied oil market. The markets responded with the S&P 500 down 3%, small caps up 1%, international stocks down 3.4%, emerging markets down 4.3%. And in fixed income, investment-grade bonds were down 2.1% and high-yield bonds were down 0.9%. For the second consecutive month, energy was the only S&P 500 sector to post a positive return. Communication services was the worst performing sector as Facebook declined more than 30%, and tech was the second worst performing sector as rising yields continue to hurt growth stocks. The Russia-Ukraine conflict is a historical event representing significant humanitarian and geopolitical concern. We've had numerous conversations over the past week about this, and we've been reminding clients to not let our emotions and anxieties control our investment responses, as history shows a pattern of short-lived volatility and drawdowns as a result of these events. Instead, it's essential to remain focused on long-term objectives. Back in the U.S., markets prepared for the Fed to raise interest rates. The headline consumer price index rose 7.5% year over year during January. It was an increase from December's 7.1% and the fastest annual increase since 1982. Treasury yields moved higher for a second consecutive month, an indication that investors expect the Fed to aggressively raise rates to ease inflation pressures. And rising yields led to a second straight month of negative credit returns in growth stocks for underperforming value stocks. The Fed will hold its next meeting March 15th through 16th, and it is widely anticipated they will raise rates by either a quarter or 0.5%. Although the 0.25% difference between the two options may seem insignificant, we believe the decision will chart the course for the remainder of 2022. If they only raise rates by 0.25%, investors may interpret the smaller increase as a sign the Fed will keep rates lower for longer. Inferring economic growth will be less impacted. If rates are raised by 0.5%, investors may view the faster pace of interest rate increases as more likely to slow economic growth and potentially trigger a recession. The takeaway is investors will be watching the Fed's next move very closely, as it will set the course for the remainder of the year. As I always mention, stay the course, and thank you for your trust and confidence.